Hi, I'm Tom Gledhill. I'm an M&A advisor for Murphy Business and the author of How to Sell Your Company and Not Leave Money on the Table. In this video, we're going to discuss enhancing your business value in today's marketplace. We're going to begin with the capitalization rate. The capitalization rate has a huge effect on your company. It's used by investors, business buyers, and bankers, and it affects any capital transaction with your company, and it's defined as that rate of return required to entice investors to invest in a particular financial vehicle or business. Let's look at some examples that you're familiar with. Treasury bonds have a very low risk, and historically they're between 3 and 6%. Large public companies, the stocks that you're very familiar with, have averaged between 8 and 12%. Large private companies between 15 and 20%. The difference between the public and private companies is that the public company stock is liquid. You sell your stock and you get cash immediately. The private company stock is not liquid. And then there's most of us, small private companies, the highest risk and not liquid, somewhere between 25 and 50%. What is that multiplier that we hear so much about? Well, it's just the inverse of the capitalization rate. So a cap rate of 33% is a multiplier of 3. Here's an equation that many of you may be recognized from basic physics. The voltage equals the current divided by the resistance. For a basic valuation algorithm, we simply change the labels to value equals income divided by risk. But we're going to focus on the R, the risk. All of the core value drivers are part of the risk. The I, or income, is taken from your financial statements and is hugely influenced by the risk. Now the I, for smaller companies, about $3 million or less, is called Seller's Discretionary Earnings, or SDE, and it's defined as net operating profit plus owner's salary plus adjustments. Adjustments are one-time expenses or other expenses that have nothing to do with the operation of the company, things like depreciation and interest. For companies larger than $3 million or so, we use EBITDA for I, and EBITDA is defined as earnings before interest, taxes, depreciation, and amortization, or simply EBITDA equals SDE minus owner's salary. One final point about valuation. The value of your company is determined by the buyers, and later in this video we'll discuss these buyer types and what they're looking for in a company. In the next video, we'll introduce you to the core value drivers of your business.